Hello, everyone. Good morning. First, I'd like to thank the conference committee for including our paper on the program. The paper I'm going to present today is Technology and Cryptocurrency Valuation, Evidence from Machine Learning. This is a joint work with Professor Yukun from University of Rochester and Professor Jinfei Sheng from UC Irvine and Wanyi. So the motivation of this research comes from the fact that the rise of blockchain technology is one of the most critical innovations in finance in the recent decade. Among many other interesting applications of blockchain technology, one early application that has received much attention is cryptocurrency, which has experienced exponential growth since the debut of Bitcoin in 2009. As of today, there are over 10,000 cryptocurrencies with a market cap of over 1 trillion, according to the CoinMarketCap. So despite this exponential growth of cryptocurrencies and the big market size, there has been extensive debates around cryptocurrencies among financial practitioners, among policymakers, and even among academic scholars. On the one hand, many cryptocurrency investors believe that the blockchain technologies is an important driving force, is an important innovation and driving force of cryptocurrency valuation, and they have intrinsic value. While on the other hand, there are also growing concerns and criticisms on cryptocurrencies. People say that they are full of speculations, scams, and bubbles. For example, if you've been paying attention to media reports around the time, you've probably already seen headlines like this, like Yellen once warned about the extremely inefficiency of Bitcoin, and Robert Shiller even called Bitcoin the best example right now of a bubble. So taken together, it seems that people in general agree that the blockchain technology behind cryptos may be good, but cryptocurrency themselves are overvalued, are not good. So one central question of these debates is whether technology matters for cryptocurrency valuation. And in this paper, we aim to investigate this question about whether the technology of cryptocurrencies indeed affect the valuations. Well, despite the importance of this research question, measuring the technology aspect of cryptocurrencies is not an easy task. Why? Because there is so limited information available for cryptocurrencies. Well, think about the valuation of a stock. What information do we have? We have the dividends, we have earnings, we have all different sorts of accounting information, right? But what do we have for cryptocurrencies? None of the above. They do not distribute dividends, nor do they provide any financial statement like 10K or 10Q. Actually, the only very widely adopted information source for cryptocurrencies is something called white papers, which is typically issued if a cryptocurrency is launched through initial coin offering. So in case you don't have a lot of background information about initial coin offering, let me introduce it a little bit. So briefly speaking, initial coin offering, also what we call ICO, is just a new fundraising tool for startups related to blockchain technology. It's kind of a mix of crowdfunding and ICO. So similar to crowdfunding, entrepreneurs can issue tokens in exchange for capital from scattered investors for their projects related to blockchain technology. And also on the other aspect, similar to IPO, these tokens can be listed on cryptocurrency exchanges for public trading. And this is at the discretion of the entrepreneur. And as you can see from the process, to attract as much funding as possible, developers or entrepreneurs, they need to carefully describe all aspects of their project in the initial coin offering, especially the blockchain technology employed in their project. And it is this unique feature of white paper that provides us with a very good opportunity to evaluate the technology aspect of cryptocurrencies. So as a result, although the cryptocurrencies issued through IPOs is only a subset of all cryptocurrencies, The availability of white paper makes the ICO market an ideal laboratory for us to study investors' valuation of technologies behind cryptocurrencies. In our paper, we will adopt several machine learning methods to construct these tech indexes, including both supervised and unsupervised machine learning methods, which I will talk more in detail in a later slide. So let's first have a preview of the main results of this paper. Briefly speaking, in this paper, we find that cryptos with higher tech indexes are more likely to succeed in terms of fundraising ability and probability of being listed on the cryptocurrency exchanges. They are also less likely to be delisted from cryptocurrency exchanges afterwards. And moreover, they tend to have better performance in the longer run in terms of higher cumulative returns, higher abnormal returns, and better liquidity. So overall, we find that technology, or what we can call technological sophistication, is an important driving force for cryptocurrency valuation. So our paper is related to several strands of literature. First, it is related to the literature on the theories of digital coins. Prior studies in this area have found that technologies can be crucial in understanding the cryptos, and our paper lends support to this literature by providing novel measures and new empirical evidence. We are also related to the literature on empirical studies of ICOs. While prior studies have found various variables that could affect crypto returns, our paper provides new insight by identifying technology as another potential variable. And finally, our paper is broadly related to the textual analysis in finance. And we are one of the first to use the machine learning methods to study cryptos. And next, I'm going to talk more in detail about how we construct our main measure, the tech index. Briefly speaking, we combine data from several sources. ICO characteristics are obtained from a website called Track ICO. The data range is from the beginning of 2017 to the end of 2018. We also obtain data from CoinMarketCap for the trading data, including daily prices and trading volume. And finally, textual measures are constructed from ICO white papers. In addition to our main measure, the tech index, which I will talk more in detail in the next slide, we also construct the traditional text-based measures like readability, tone, uncertainty, etc. Well, to construct our tech indexes, we mainly use text analysis to analyze the content of those white papers. And in particular, we use both supervised and unsupervised machine learning methods. So for the supervised machine learning method, it's like a top-down approach that could closely imitate the way investors evaluate white papers. More specifically, we first manually assign scores to 200 white papers as the training set, and we then train the model based on them and extrapolate it to the remaining white papers, just like any other standard supervised methods. And we also use methods based on unsupervised machine learning methods. So these types of methods is like a bottom-up approach. And the advantage of these types of methods is that it requires little human input and expert knowledge in the very beginning. And you can try to interpret the results after you get the topics. Here, we construct two unsupervised methods, the embedding-based index and the LDA-based index. For the embedding-based index, it is done by first applying word embedding to map the linguistic words to a numeric vector. So each word becomes a vector or a dot in the vector space. And then we apply the k-means algorithm, one of the most widely adopted clustering algorithm, to cluster all words into 20 different topics. And the LDA-based index is done in the similar way by applying LDA to build a 20-topic model. And it is important to note here that the number of topics, the 20 here, is not chosen arbitrarily. Specifically, we follow standard or scientific metrics to choose this measure. For example, you can see from the left panel, we use a metric called elbow method to select the best number of topics for k-means clustering. And on the right panel, we use a metric called the coherence score to build the most coherent LDA topic. In general, we follow standard procedures to do this model selection and try to minimize the level of subjective choices in the process. And note that for these unsupervised methods, although we can figure out which word belongs to which topic, we do not have a label for each topic, and we do not understand the relation between these topics. So to better understand these topics, we apply some further methods. So as you can see from these two panels here, on the left panel, it is a taxonomy, which shows how each topic can be grouped into a broader topic. We first manually label the name of each topic based on the keywords in each topic. And then we use a method called automatic agglomerative clustering, which automatically generates this taxonomy tree. And on the right panel, it is a graph showing the relation between each topics. The size of this circle, well, each circle is a topic, and the size of each circle indicates the number of words in that topic, and the distance between circles indicating the distance between any two topics. This graph is done by a dimensionality reduction technique that maps the topics onto a two-dimensional space while preserving the relation between topics. So if you look at the output of these two graphs, you can see that topics like blockchain, information, and system, they are either clustered into a broader topic in the left panel or adjacent to each other in the right panel, suggesting that they are conceptually related to each other. So as a result, we use these top three topics as the technology-based topics to build our tech index. And we follow similar procedure for the embedding-based tech index. So after successfully locating or identifying the tech topics, the tech indexes is simply calculated as the percentage of words that belong to these tech topics. And finally, we also construct a composite index, which is the simple average of the three indexes above. And in our regression analysis, we will show that our results, all our analyses are robust to any of these measures, suggesting that the results are not driven by any data mining or parameter choices during the construction process. And next, to better understand the tech indexes, we next start to analyze the determinants of the technology indexes. Specifically, we link it to a bunch of cryptocurrency characteristics, like whether the coin is developed on the Ethereum blockchain. We link it with GitHub data, white paper information, and compare it with other ICO characteristics. And this table shows the regression result. Here, the dependent variable is our tech index. And you can see the first column shows that for cryptocurrencies developed on the Ethereum blockchain, it's associated with lower tech index, which is something consistent with our prior, that the coins, the cryptocurrencies that are backed by their own blockchains should be associated with higher tech indexes. This is the takeaway from the first column. For the second column, we link it with GitHub measures here we use a variable called commits. It's like the number of revisions developers submit on the GitHub. So it kind of captures the commitment or the devotion the group, the developer team is into this project. So you can see here that the devotion, the commitment is positively related to our tech index, suggesting that it indeed captures some aspects of the technology team behind. And in the third column, it shows that cryptocurrencies with more ambiguous white papers or ambitious white papers, as suggested by the tone and the uncertainty here, they tend to have lower tech indexes. And in the fourth column, we find that cryptocurrencies with larger and more reliable teams, as captured by the team size, and this has Twitter dummy here, are associated with higher tech indexes. So this taken together, this determined analysis suggests that our tech indexes indeed capture some meaningful information about the technology behind the cryptocurrency, and these are all consistent with our prior expectations. And next, I'm going to move on to talk a little bit more about how our tech index is related to the cryptocurrency performance and also the main results of the paper. Well, we adopt the following empirical specification. We use several outcomes of ICOs in our paper. The regression models are similar, so let me illustrate the design with the ICO success as the dependent variable. So here, success is a dummy indicating whether it's listed on a cryptocurrency exchange. Of course, it could also be whether it's raised and funding or not. And on the right-hand side, the key variable of interest is this beta here. This beta is the coefficient on our tech index, and our expectation is that the beta should be positive. The higher the tech index, the better the technology, the more likely that the project is to succeed in the future. We also control for a bunch of control variables about ICO characteristics and white paper characteristics, and also fixed effects to control for the time pattern, the industry difference, and the geographical difference. And here is the regression results of this specification. We first analyze how tech index is related to ICO success. Here we consider two dependent variables: trading, indicating whether the coin is later traded on a cryptocurrency exchange, and capital raised, indicating whether the project successfully raised any funding or not. And the positive coefficients here suggest that when the tech indexes are high, the cryptocurrency is more likely to raise funding and more likely to be subsequently listed on cryptocurrency exchanges. And note that the magnitude here is also not small. For example, a 1 standard deviation increase in a composite tech index leads to an increase in the listing probability by over 5%, which is about 21% of the mean. And also, by the way, due to the limit of space, I show the result using the composite index, but in the paper, we show the result using each of these each of the index we described above, and they are all consistent. So this is the result about tech index and ICO success. And then next, we link it with the coin's subsequent performance on the cryptocurrency exchanges. We consider both short-term and long-term returns. And you can see that if we first consider short horizons ranging from 7 days to 90 days, when we use the Bitcoin adjusted abnormal return as the dependent variable, the coefficients on tech indexes are not significant, suggesting that tech index is not related to the short-run performance of ICOs. However, if we expand to longer horizons ranging from 180 days to even 300 days, you can see that now the significance becomes apparent. It's positively related to long-run returns. And taken together, these two pieces of information suggest that although investors may not be able to recognize ICOs with high tech indexes in the short run, but eventually they are able to value them in the long run. So this is like a delayed reaction mechanism. And moreover, we also link the tech index with the future delisting probability of cryptocurrencies. And the result shows that coins with higher tech indexes are less likely to be delisted subsequently, as we can see from the negative coefficient here. So taken together, we have seen the results on ICO fundraising success, on short-term and long-term return, and on delisting probability. And due to the limit of time, I will briefly discuss a bunch of additional results here to support our delayed reaction mechanism. The first piece of evidence is that we find that the long-run horizon return predictability is weaker for cryptocurrencies with high readability. Let me put it in another way. So this basically means that for cryptocurrencies whose white papers are harder to read, it takes investors a longer time or harder to understand the meaning of it. So as a result, the return predictability becomes weaker for these groups of tokens. So this is one piece of evidence. Another evidence that rules out the overreaction mechanism is that we test for the existence of reversal pattern, and we find no evidence of long-term reversal, suggesting that the return predictability is not due to some sort of overreaction of investors to the ICO bubble. And in addition to that, we also show a bunch of robustness tests, including other measures of ICO success, a logic regression model, and new measures of returns that deal with delisted coins. And taken together, our results are robust to all these alternative choices. And before I conclude, I'd like to provide a little bit more comparison of our tech index with other simpler measures of technologies, because one question that we typically receive in the past is, why do you go all the way to use machine learning to construct these measures? Why don't just resort to some simpler metrics? Like, you already have the GitHub data, why don't just use GitHub? Or why don't just build a word count measure? So here, I'd like to compare our tech index with these simpler metrics of technology and show that our measure indeed provide additional explanatory power in addition to these measures. So you can see that in the first three columns, I regress the dependent variable is the ICO success. I regress each of these metrics on it, and they are all significant, suggesting that each of them has some sort of explanatory power. However, when we try to include multiple measures in the regression, you can see that our tech index is always significant, although the GitHub measure also always maintains significance, but it absorbs the explanatory power of a simple word count measure. So the fact that it remains significant after controlling for all these alternative measures suggests that it provides additional information, additional explanatory power beyond these simple measures. So in other words, the complexity of this measure makes sense and pays off. So finally, let me conclude. Well, in this paper, we construct a set of 4 text-based technology indexes from a comprehensive sample of ICO white papers. The main finding is that technology or technological sophistication is an important driving force for crypto valuation. We find that ICOs with higher tech indexes are more likely to succeed and less likely to be delisted. And although tech indexes do not significantly affect the short-run returns, it has positive impact on their long-run performance. So taken together, our findings have some important implications. To policymakers, we suggest that it's necessary to add additional disclosure requirements and guidelines for ICO white papers. And for investors, this means that there is indeed valuable information that we can obtain from white papers. And that concludes my presentation today. Thank you.
Thank you, Wanyi. Great presentation. And I believe you tackled there a really, really important question, which a lot of us have constantly on their mind. How do ICOs actually priced? Why do they have value? What's actually going on there? Then I would like to invite Ben Charoenwong from National University of Singapore to discuss your paper. I understand he has he has looked deeply into your results. So could you please stop sharing your slides and he can go ahead? That will be great.
Sure. Hi. Can you see my screen?
Yes, I can.
Great. So may I start?
Stage is all yours. Thank you so much.
Okay, thank you. And thank you, Wanyi, for doing a great job presenting your paper, because I could not discuss the level of technical sophistication in your paper. So I'm glad you covered it very well. Yeah, so I'll be just making 3 points. Just to quickly run through the summary of the results here. I think, conditional on constructing the measures, the results are fairly straightforward, right? The research question is, do investors value technical sophistication, which is extremely important if we think that, ICOs are, real assets that at some point they're going to be used to do something that's going to be meaningful, some kind of meaningful economic activity. And this is the means through which, these quote, quote, companies fundraise, right, to kickstart an ecosystem. Whether or not investors who are participating at the ICO stage care about the quality of the project is important. So the paper constructs 4 white paper text-based measures of technical sophistication. Most of my comments will be the discussion on what exactly is the measure. The results are, predicts long run, but not short-term returns, less likely to delist in the future, more trading volume. Actually, I think you skipped the trading volume result, which I think actually is extremely important. So if you have more technical sophistication, according to this measure, you actually have more trading volume, both in the short run and in the long run. Okay, I hope I did not misrepresent your results. Overall, extremely impressive work. There's a really thick appendix detailing how they constructed this. I actually just sent this to some of my master's students who are interested to try to do text analysis. So I think it's a great summary and it goes into a good level of detail. I'm going to make 3 comments, and I'm sorry for those who are sitting in the classroom there, our seminar room, that the text is a little small. So in the conclusion, the authors make this statement that maybe it makes sense to regulate white paper disclosure. So the first conceptual question I have is, this kind of disclosure is voluntary, right? But to what extent is the white paper actually a commitment? And it's worth remembering that this white paper information is provided before the ICO, right? And some of the GitHub stuff actually comes after. So it actually might be interesting to look at that. So I'm going to come back to that in a little bit. Just for descriptive statistics, for someone who doesn't study this or doesn't have the data readily available, it's useful to know, how long they have the paper before the ICO. And this is going to matter for the theory, which I'm going to talk about in a little bit. And also, how frequently does the white paper get updated, right? And then at that point, of course, the caveat should be, when did you actually download the white paper? Which vintage do you have? Because some of these cryptocurrencies do pivot a little bit, right? Or make some kind of technical upgrade, as we are, carefully watching with Ethereum and the merge, right? The almighty merge, which is coming soon. And it's also interesting to think about whether or not disclosure actually becomes a commitment device. right? And so, as part of the validation of the measure, which is actually, my second comment, is a more quote, quote, sophisticated paper, does it predict more trading activity, right? In some sense, is having a good, measure on the white paper, is that really about the project and the quality of the project in terms of, am I doing zero knowledge proofs, right? Or, something really advanced, cutting edge computer science, or am I just better at planning, right? And we should remember these white papers are voluntary, and there has been some work actually linking the disclosure overall, right, onto the with the success of the ICOs in general, right? And we should think about who are reading these white papers, right? Because there's some statements in the paper that suggest, we, like you, me, all of this finance people who are sitting in this audience, we are the ones reading the white paper. And, having tried to read some, I actually don't really understand them, right? So it's not obvious whether or not it's written for us or some kind of expert information intermediaries, right? And there are companies like ICO Bench, right, that have a list of experts who actually specialize in reading this and actually providing a rating, just like sell-side analysts. I'm going to skip some of the other stuff, but I think the last point here, I'll spend a little bit of time on. I had a pretty hard time mapping the white paper to theory, because there's some theory that's cited. So I'm going to go through Will Kong's paper real quick. That paper is very simple. I don't understand how the white paper maps into their paper, because in their paper they have an arithmetic Brownian motion with a positive drift. So the network automatically gets more productive over time. There's no notion of, information asymmetry. Now, I might be wrong. It's been a while since I've seen the paper, and it may have been updated, but to me, it's not that obvious. I think Sokin and Sheng actually provides very sharp predictions, which I think you guys can really use to sharpen the contribution here, where they have the adoption of cryptocurrencies to transact, right? So thinking of this as utility tokens. I need to use the coin to do something. They have actually a very interesting result that actually says the trading price and returns of the coin itself and the ICO is not informative about the value of the health of the currency. In fact, you do need to combine it with volume, because their theory features multiple equilibria. And the thing that actually distinguishes between the good equilibrium and the bad equilibrium is actually volume. All right, so your findings are actually you have higher returns and higher volume. So you're more likely to be in the good equilibrium, where the coin gets adopted and becomes widespread. So it makes sense that you don't enter a death spiral, right? You've kind of been adopted and widely used. And it might be useful to think about subsetting the ICOs here. The paper mentions some subsamples, but actually they're not. They're kind of interactions. So it might be just worth like throwing some of these coins out to see if the results still go through, or if it's even sharper, right, in the coins where you're actually using it to transact, as opposed to like security coins, what you guys call security tokens. Measure number two, comment number two. I don't know what is this measure. Okay, so you guys call it technological sophistication. I'll butcher it and called it technical. I just realized that it didn't line up, but I have here at the bottom these words, these topics that are picked up from the white paper, right? So we have Ethereum information blockchain system typo. I'm not sure what that is. Another typo. And then token, music, travel, trading, payment, business, finance, community, marketing, mining, law, disclaimer, social media, game, and gamble. Looking at that, it's not that obvious to me that, having more of these words means I'm more technologically sophisticated, right? So it could, to me, actually, a lot of this is actually about industry classification. Maybe about the disclaimer, right? Or the community, how you plan to be the community. That might be part of the sophistication there. But I think, the paper should like very seriously consider validating that this measure actually predicts sophistication, or try to, clean up the variation in there to get rid of some of this industry stuff and then focus on the technological part. It might be worth thinking about validating it. Does this measure predict academic publications? So I have an example here, Algorand, who one of the founders is a guy at MIT, right? They publish stuff. Or, is there a high similarity between, cutting edge computer science work or computer engineering papers with the white paper? Right. And there's some research that actually traces back Bitcoin's history through, Merkle trees all the way to 1980s, right? You can kind of guess where Satoshi Nakamoto came from and so on. But I think it's important to keep an eye out and kind of show a little bit more information on what this thing is, because I think, performing LDA and then just saying that this is sophistication, it's not that obvious to me, right? It could just be, ICO, white paper quality, loosely defined, right? And okay, I'll skip some of these other papers, but a lot of people have studied ICOs, so the hurdle here would be you have to differentiate, right? You have to show your mechanism will survive, their mechanism, which may sadly involve also getting some more data so you can actually conduct the robustness test. I also think the sophistication versus fog index is extremely interesting. It has to do to me with the precision of the signal, right? So there's like a level of how good the paper is, and then there's how clear or unclear, right, as another dimension. The thing that immediately comes to my mind is something like information cascade, right? This idea that, well, we're going into ICO, especially if the length between the white paper publication and the ICO is very short, right? Each individual investor has to have some signal of whether or not you think the ICO will pass, right? Is a good quality or not. But if you actually have a very high quality white paper, it can make people abandon their own private signals, right? So this is an information cascade, right? So you can herd into it. There's a lot of very interesting work here. The immediate paper that comes to mind is Will and Yi Zhou's paper. It's still a working paper here. They actually have information cascades in a money raising crowd financing with a threshold, which is, I think, exactly what an ICO is. So it might be a useful framework also to give you some more hypotheses to test. I'll just run through comment 3 real quick. I know I'm out of time. Empirical specification, I would say, let's give the white paper length a fair shot, right? And at least like take the log of the zipped text file. So it's some kind of information entropy rather than the number of words. And you can kind of horse race that to see if that's still there. I mean, I can let you read these other things. I don't think they're that important. Overall, I mean, it's a lot of very good work. It's an extremely interesting data set. I can see the amount of effort that went into it. I think it needs a bit more, brushing up on the framework. And I think then it can actually be positioned very cleanly through the lens of the existing theory. So it is a unique opportunity to test these theories. All right, so that's it for me. Thank you very much.
Thank you, Ben, for discussing this paper. This was really detailed. I hope Wanyi finds this also helpful for her work. Wanyi, is there anything you want to react to directly, what Ben just said?
Yeah. I think, first of all, thanks, Ben, for so many great comments. They are super helpful. I think a lot of them really lead us to we need to dwell more about later on, to think closely about it, especially about the part about how we position the findings with the theory. I think that part is super helpful. And I think I didn't think that closely about that before, but I will definitely have a long discussion with my co-authors afterwards. And also, I'd like to reply to a little bit more about some other comments. And I think they are also related to the comments, the question that I see in the chat box. So if you don't mind, maybe I can just reply to them together. So there's one question about the validation of these measures. And indeed, we think that it's kind of, it's very important to validate our text-based measure with something more fundamentally related to the technology aspect. I think the idea about validating it with the publication outcome is brilliant, which I haven't think of before. But one thing we did in the paper is we link it with the GitHub measures. I only briefly touched about it in the presentation. I should probably mention more about it, but basically we verify our tech index with a lot of metrics from GitHub, including the stars, the forks, basically it measures the impact of the repository on GitHub. And I think this is related to the comment from Jin. And indeed, our tech index is the correlation is super strong, is positively related to all measures from GitHub. But again, I think there is also some possibility that GitHub may not be that direct of a measure of the technology aspect. So we should probably look at the publication outcome as well. And then there's another question, and also mentioned in Ben's question about the sample size. Right now, it's from 2017 to 2018. That is mostly because we kind of started this project at the end of 2018 or the beginning of 2019. But now we are in the process of expanding the sample size. Of course, it's a lot of work, but hopefully we can get it done pretty soon, so we can have larger data and test more, and also verify what Bo-Fu just mentioned in the chat box to also take into account the cryptos that are listed afterwards, after our sample period. And yeah, I think that's mostly about my comments. Thanks again. I will definitely, maybe we can have a little bit more communication if I have further questions about your comments. Thanks so much.
Great, thank you, Wanyi, for also directly going into the questions we had in the chat. Then we're already in the Q&A, so let me see if there are any more questions from our audience, online, offline, either. Then maybe allow me like a quick clarification question. So in your control variables, do you also control for the general performance of the crypto market? So say if the Bitcoin price goes up, is this controlled for, or would this potentially be also absorbed by your by either of your variables?
That is a very good question. Excellent point. So in our regression specification, we control for Bitcoin price in all specifications, except the one using Bitcoin adjusted returns as dependent variable, because it's already taken into account on the left-hand side. But for all other specifications, we use Bitcoin price to kind of control for the the market sentiment. So I think we already take that into account. If that solves your question.
Yeah, definitely. And how is it like with the, let's say, gas price, for example, since various of these projects will still be built on the Ethereum blockchain or a different blockchain allowing for projects being built on it. Say if the gas price is very high, this may also cause simply projects to default, simply because it's too expensive to still interact with it, but may also explain why ICOs with its own blockchain are more successful in your sample. Is this somehow accounted for?
Actually, I'm not very sure if that's accounted for, but I think probably not, because I think we're kind of talking about maybe an interaction term, or like a subsample analysis about the market timing. So probably maybe one thing we can do is to kind of separate the sample based on the Bitcoin price, or maybe add an interaction term about it and see how the coefficient loads on the interaction term. I think that may be able to kind of capture the mechanism you just described, but we probably haven't taken that into account in the current specification.
Right, I think that would work. You might also consider just to input kind of a smoothed index of the gas price of the Ethereum blockchain, and a second or third one, which are popular for launching, where most of your ICOs launched on. This could also solve your issue very directly, and then you will also see the significance of it. Yeah, just a suggestion.
Although I think you can also put a time block fixed effects. So then you're focusing on the cross-sectional differences. Although on that, right, because the sample is quite short, and I think a lot of ICOs are clustered, you probably want to handle the standard errors somehow, right, to account for the cross-sectional correlation. At this point, they're just robust, which I'm very sure is not enough.
Yeah, absolutely. So right now we have like quarterly fixed effects, which kind of takes the time trend into account. But yeah, definitely we should also consider the standard errors clustering as well. Yeah, thanks so much from both of you. The comments are great.